Good morning, ladies and gentlemen. Unfortunately, the wrist dial still not working, still not displaying properly, but we are working on it and making progress. So I would have thought that this week it will definitely be fixed, but don't worry, it's showing nothing significant. Tops are a process, not an event, and as we will see, the spreads are not showing any imminent signs of completely risk off. In fact, they are showing an intensification of risk on. I don't think that that is right, as I will explain later on, but basically what they're showing is that bonds are the weakest category and will continue to be the weakest asset class, probably followed by gold, and finally equities relatively stable within a wide range. Let's examine each individual component now. The yield curve is showing very mixed signals at the moment. And as I tweeted out on Thursday, I believe, that is normal at the onset of this QT that the Fed has signaled. It's not QT, it's just tapering. It's just what is it? Well, they're just buying slightly less. They're continuing to buy, and they will continue to reinvest. So the amount of support that the markets are receiving is still big. It's just not humongous, and that was to be expected. What is the yield curve showing? Well, the 2s10s steepened quite appreciably. They are knocking on the door of 119. And yes, could they go to 127? Quite easily. But I think that any steepening of the yield curve is going to be very, very contained. It's not going to be anything special. I think the belly of the curve, the 5s to 10s area, is going to be the weakest area. But at some stage the 2s will suffer too, and we will look at each tenure, and I will tell you what I think is going to happen over time. The important parts of the yield curve, like the 5s 30s, well, we actually reached 95 basis points on Wednesday, I believe it was, and then you can't see it here because this is a weekly close, but then everybody just tried to get out of the position, and we closed, what did we close at? 103. So on the week we had very little movement, but intra-week we reached 95 and then came back off. This is perfectly normal. In my experience, I've seen it many times when the yield curve reaches certain levels on an event, like the Wednesday announcement by the Fed that they were very close to doing tapering, and that will probably happen at the next meeting. What happens is that people then try to get out of all positions, and especially in 30s, what happens is there are suddenly no bids and the market just collapses. That is perfectly normal. We are doing something like we did here. This is nothing to be worried about, even if it starts coming through. I am really not worried for the 30s. And you can really see from the 10s 30s that the inflation expectations are actually being flattened out. They're not increasing, and that the 30s are still well bid against the 10s. I think what is happening is that you get the area between the 5s and 10s suffering, and eventually I would really not be surprised to see a completely flattish yield curve. But it's going to take a lot of time for it to happen. In the meantime, while people are adjusting their positions, it should be no surprise to get another little dip in the 5s 30s, which will be very buyable. This is the 2-year note, and really we closed at the highest close that we've had for this whole move. To me, this suggests, even if we have a couple of days of backing and filling, that eventually we break higher. If we go and have a look at a much longer chart, we will see that really the first sizable resistance is going to be here around the 50 basis points mark. To me, the risk reward in 2-year notes is very much that we break up towards the 50 basis points level, and that makes sense. Now, whether we think that the first tightening is going to happen in 2022 or 2023, the market will always overshoot and discount it probably far earlier than it's going to happen. The likelihood that we now break underneath 15 basis points is almost zero. So you're getting, every time it dips, if you buy 2 years, you are looking for a 4-to-1, 5-to-1 risk reward, which is very good. To me, the euro dollars from 2022, from September 2022 to call it September 2023, are really sells on every uptick. And that is what I keep on doing, and that's why I have the options. But to me, the 2-year, its eventual target over the course of the next 6 months is going to be around the 50 basis points area. These are the fives, and as you can see, we're knocking on the door here of 96 basis points, 97 basis points, which was the previous high. Couple of days of retracement, and then we should be breaking higher. We should really, my guess is that we're going to stabilize or reach a level like 116, 117 basis points on the fives. I don't think that we will be doing much worse than that, simply because this is the area that we were trading in before COVID struck. I think it's going to take an awful lot and an awful long time to go, above 140 basis points. That's unlikely to happen for a very, very long time. But any dip here down towards the 85 area in the fives, to me, is a buy and I'm absolutely positive that we will see 116 basis points over the course of the next quarter or so. These are the 10s, but the 10s and 30s are much more difficult to forecast. I think they should meander far more than the 2s and 5s over time. I think that the likelihood of us breaking these 169 level is very, very, very low. And I will show you why in a second. But those are the 10s and these are the 30s. Really, if you look at it in terms of TLT, and I'll enlarge the TLT area, to me, the likelihood is that we stay in an area between 140 and 148 for the foreseeable future. I really cannot see this market crashing through this 137 area. I think we will be in this area for a very, very long time. And that eventually will allow the market to, the yield curve to flatten. So to me, 220 is about as high as I can see the 30-year for the foreseeable future. And at the moment, basically what they did is they threw the baby out with the bathwater because they had to get out of this position because they sold the yield curve and they wanted to get out of the 30s position. Well, the market makers are going to make it as difficult for them to do that as possible. But eventually this kind of area is going to cap it. There is no inflation. There are no inflation expectations, and I will show you that now. This is the 10-year break-even inflation rate. And as you can see, yes, we went up a couple of basis points, but we're still very much in this range that we've been in since the beginning of the year, and really since the beginning of the second quarter. For bonds, and especially the 10s and 30s, to start breaking the upside levels that I just shown you, these inflation expectations need to start breaking upwards. But if you have a look at, this is now the five-year forward inflation expectation rate, it really has not moved over the last few days. In fact, if anything, it's coming in. We really need to see it above 230 for me to start being in the least concerned that we're going to have a significant leg higher in the bonds and the 10-year notes in terms of yields. That is just not happening. The announcement by the Fed is deflationary in the long term. Expectations of inflation should stabilize to come down. And when that happens, that is going to anchor the 30s and the 10s and de-anchor the 2s and the 5s, because the yield curve should really flatten. As the Fed tightens policy, whether tightening is the right word or not, it doesn't really matter, as expectations that short-term interest rates will rise at some stage, whether that is the third or fourth quarter of 2022 or the first or second quarter of 2023, that is really less relevant. It's just a question of timing. As those expectations set in, and these inflation expectations don't de-anchor to the upside, the yield curve can only flatten. And when that happens, when we have a flatter yield curve with 2s at 50, 60 basis points, with 5s around the 1% mark, 110, there is no way that 10s and 30s are much above the current levels, and that eventually is going to be supportive for things like technology stocks, but that is eventually. In the meantime, we're going to have much more volatility. How are things looking in Europe? Well, much the same as what I've described in the US, just slightly less so. Now, we all know that the ECB is way behind the Fed, and we all know that that Christine Lagarde is about as dovish as doves come. So it is normal for the market to be retracing here in the US 10s against German 10s, and basically we came out of this tight range around 163 and we closed 167, and we can get up to 173. My argument is that we will not see much movement here. The expectations for the Fed tightening cycle, let's call it like that, are not very much. What are they going to tighten? Even if you look at the most hawkish dot plots, they're talking about four hikes over the course of 3 years, and that is at 1% of tightening. And how much have we discounted already in the euro dollars? Well, we are very, very close to discounting all four in the back months of mid to late 2023. In which case, how much can this move? Can it move 5 basis points, 6 basis points on the upside and get up to around 175 where it was, let's call it, a month ago? Absolutely, but that is not a tragedy. That to me tells me that that Europe will move the same way as the US, just a little bit less so. What does this mean for the individual tenures in Europe? Well, this is the bubble, And really what it says is that at this level, around minus 64, 65, there is absolutely no value in bubble, and you can get very aggressive when it retraces, when it retraces to about there. And that is approximately 135.50 in the bubble. The likelihood is always going to be that we trade up to this kind of level, minus 52 basis points, and then remain in a range between minus 52 and minus 64. Whenever we get to this kind of level, is going to be a wonderful, wonderful sell in futures, because the trend eventually is going to be higher. Eventually you will get the ECB on the same page as the Fed. I think we're a long way away from that, and therefore it is unreasonable to expect that these are not very good levels to take profit on any short futures positions, because it just will not break yet. And the possibility of this kind of action is always present. 2 days, 3 days of action that gets you back to this kind of level, and then it goes again. That's probably where you're going to get a repeat of for quite some times in Europe. If we now look at the Bund, I would have thought that the likelihood of us going much higher than minus 13, minus 14 basis points is not huge for the time being. Basically, it's going to be a repeat of these patterns, just shallower on the downside, much shallower on the downside. I would be shocked if we see the Bund lower than minus 33 for quite some time to come. So basically, my favored way of trading the Bund will be basically sell the RIP in futures for quite some time to come. France is actually probably the clearest here. I would have thought that this kind of level around the 20 basis points mark is going to be a very tough level to break, then dips back down to this kind of level, 04, 05, to go again. It's going to be, I wouldn't say a frustrating time, but it's going to be a time where all these rips in the futures that 6 months ago were actually opportunities to follow it rather than not, are going to be very much resisted. And people are going to start anticipating that quite some time after the Fed, whenever that might be, the ECB will have to follow their path. From what I've just said about bonds and European bonds and their differentials, it seems that the dollar is supported as a result. We closed on Friday above 93.14, only for the second time. To me, the path of least resistance is up towards 94.20, 94.70. As looking on a daily basis, we are crawling up this Bollinger Band. At some stage, we will break 93.63 and go up to these levels that I mentioned in the high 94s. 95.07 is probably not unrealistic over the course of the next few weeks. And what does that mean for Euro USD? At some stage, I think Euro USD has to trade this 115.30 to 114.50 kind of area. To me, that is the natural area that one should expect Euro USD to trade over the course of the next couple of months. What's better than breaking these 116 lows, get everybody bearish down here, and basically then return upwards. I don't think it's going to go very far, because I don't think the interest rate differential move is going to be that big. But to me, while people are looking for the Fed to tighten first and speculating about that, the likelihood of the dollar being very weak are not all that high. You can see how the 200-day moving average has turned, 50-day moving average is below it. The pressure should be on for these levels around the 115 to 114 area. From what I've just said about bonds and actually the US dollar, you can see that the pressure, I think, is going to be on the downside in gold still. I really can't see it. There is absolutely no reason to own gold, given the macro picture which I've just talked about. Gold you want when the inflation expectations are becoming de-anchored, and which basically means that bonds, even higher bond yields, are not filling up the differential between what inflation will be and what the yield of them is. That is not the case at the moment. Therefore, gold will remain weak. I see no technical, no fundamental reason to own gold. What I do see is a reason to own DBC, and you can see from the chart from DBC Gold that it's making new lows constantly. It's saying DBC is a much, much better hedge than gold. If you want a hedge, own DBC. It's just as simple as that. What is DBC doing on a weekly basis? Well, it's breaking higher. Is it going to go a million miles at a million miles per hour? Probably not. If we enlarge this area, you can see that it's respecting the Bollinger Bands very nicely. These will only come up very, very slowly. What does it say? It says that DBC, might well crawl up, but that doesn't mean that gold has to go up with it. It can just go sideways to down, and that actually satisfies the spread that I showed you earlier, this one here, and takes it back down towards this 638 level, which is a very, very long-term average. Okay, this was the outlier, not this. So, if we come back into this area, so what? Basically, that is stability for gold, stability to down. It's not an argument to buy gold. And every spread of other asset class that you look gold against says the same story apart from the bonds. The gold is only holding its own against bonds, and this is AIU TLT. That's all it's doing. It's remaining above this very important line, but it's not impulsive even there. Look at it against SPY, look at it against ACWI. It's going up. Basically gold is losing to both equities, US only, and the world. So basically what this is saying is this is not a risk-off gold buying period. There is no reason to expect it will become one. All it is stability in gold against bonds. And if bonds are going down, it just means that gold is going to go down less so. It really is, there is absolutely no reason at the moment to own gold. Well, equities had a relatively exciting week, didn't they? But net, nothing really. What did we do? We basically filled in what looks like an ABC. We came down to the tick to, and I'll enlarge this area so we can see it, came down to the tick where it should have gone down on an ABC projection, and that's it. I will now get rid of it. I just couldn't get bearish really all of last week. I was hoping that it was gonna get down here to 42.55 to buy the crap out of it. But what are we really seeing at the moment? We are basically seeing either the commencement of a topping process, or just a pause before we break out to new highs. In either way, the market is going to be contained, and that does not give me any kind of big, I don't know, excitement that I have to chase anything, or that I have to do anything but play the levels. And funnily enough, the levels are completely unchanged. There is nothing new about the levels, and here we are. You know, this is the 195-minute chart which I use, which seems to be working very well. The magic 44.26 level, to me, at the moment, that is going to be the swing level between bull and bear. I would be very, very surprised if we managed to break the 44.80 level with any conviction any time, but it would not surprise me if we trade it. Absolutely not. If we do break it, it's more bullish than I thought, but I think the likelihood, while the bonds over the next couple of weeks readjust to higher levels, it just makes sense for the market to be in a 44.80 down to 43.88 kind of range, and for this volatility to be taken out of the market. And that is precisely what vol did in the past 3 or 4 days. And we'll look at that later, but it just telling me that this is either the beginning of a topping process, which could take, I don't know, several weeks, if not months, or the beginning of just a short-term bottom before we start making significantly higher highs in the fourth quarter. I don't know which it is. It'll depend on bonds, but if I am right and they stabilize at the levels that I said, they're really not that bad for equities. In fact, longer term in equities, once the bonds have readjusted, equities only have one way to go, and that is higher. What actually surprised me, not surprised me, but comforted me most last week was how orderly NQ was. If you remember, I said that the market can only go, SPX can really get slaughtered only if NQ contributes, i.e. if NQ goes down more than SPX. And it just hasn't happened. It was all very orderly. It never really closed below the really important levels that I highlighted. And not even, I mean, what did it trade? A couple of hours below it and then straight back up to this kind of level. These are signs of stability. The market is trading stable, and that tells me that the likelihood is that we are in a period of consolidation before we make another move higher. What does surprise me is that these spreads are as strong as they are. Now, this is XLK over SPY. You would have expected with bonds going higher that XLK would be, coming off. And here we are right at the very, very top of the whole, at the all-time highs. If we look at NDX over SPY, okay, it's meandering here, but it's very close to all-time highs. That is not the expectation. That is not the behavior of high-growth stocks before they turn over, and collapse a million miles. And also, if you ever look at NDX over DJY, it's staying above the all-time highs. All it's doing is taking out any excess, ready to start going again. All these are not signs of an equity market which is turning into risk off. They just aren't. So to me, the likelihood of this being a period of consolidation before we break out to new highs is much, much higher then the likelihood that this is a topping process in general in equities. More evidence is SPY EWJ. I told you I expected it to come back towards 6. It's got back towards 6 and now it's stabilizing here. What does that mean? To me, that means that SPY, SPX, INX, whatever you want, is going to trade more or less on a par with the Nikkei. Maybe a little bit better on some days, maybe a little bit worse on others. But more or less, now that it's reached this equilibrium and that it's basically taken out all these excesses here, it should be trading on a par. If we have a look what the Nikkei is doing, well, the Nikkei is basically building a range of weekly moving averages, which are now below the market, which are going to be supportive, between 28,180 and let's call it 28,900. As long as the market doesn't come down below there, that is very supportive and it's going to allow for these weekly moving averages to come out and go upwards into the fourth quarter. So to me, Nikkei is holding the key to what is going to happen to SPX at some stage. At the moment, this says that we're going to remain in a range, and why not maybe doing even an ABC, which is going to allow for that 42.55 level in SPX. That would be wonderful because I think that would be a wonderful risk-reward buy. We're having, maybe an ABC down towards this 29,000, 28,600 area. As long as it doesn't break this 28,335, to me, Nikkei is building a base, a bullish base for the fourth quarter, and SPX is doing the same. Finally, I wanted to show you XLY, XLP. XLY, XLP tends to be one of the best risk-on, risk-off indicators. And where is it? It's knocking on the door of all-time highs. That is just not the behavior of spreads if they are signaling that we're going to have a weak period in equities, or that we're turning into risk-off. God forbid. This is just not it. XLY, XLP has really been a very good indicator throughout, even when at the height of the pandemic panic here in March, it was showing that there was really nothing bad going on. It was puzzling down here. It was not puzzling up here, was it? It was saying XLY, XLP was right all the time. To me, this is just not the behavior of a market which is about to complete a top. Even if it's in a process of topping, this is really not what you expect to see in this very, very pivotal spread. I think deviations are basically telling you the story at the moment. You have, as I explained in the relationship between the Nikkei and the SPY, do we have the opportunity to make a low in here? We do, but I think it's going to be a very brief one. But if we look at the sectors, we will see the ones which are showing potential to the upside. And at the moment, they're very few and far between. Even if XLU were to rally all the way back to the center line, it has such a small percentage in the SPY that it's really not going to do anything to it. It's going to move it like a couple of basis points. XLB is going sideways. XLK, it's just showing the kind of stability that I think it's much more likely to persist over the course of the next month or so. The one that could make new highs here is XLF. It has the bond move as a tailwind. It could easily get into the red, but I don't think it goes very far if it does. So that tells me that there is a decent period of stability ahead, and actually volatility says so as well. Volatility killed people last week, and what I find amazing about the technicals is that, I've been saying for weeks and weeks and weeks that we have this gap up to 27.55 to fill in volatility. It did it on Monday and straight back down into the range. The volatility closed much lower than the market went up. That is a sign of stability, and also a sign that we probably come and fill this gap down to 1670 on the cash, and then fill these gaps up here around, above 20, and there's another gap here to up to 24. So that's what tells me that yes, we probably trade. How does that equate to what the market does? Market goes up to 43.80, sorry, 44.80, and volatility comes down here, and then market shoots back down from 44.80 down to, I don't know, below 44.26, and volatility shoots up here, covers these points, and then the market volatility comes back off, and the market basically comes back to where it is now, where it closed on Friday. That's the kind of scenario. So what it's saying to me is don't expect net big changes in pricing levels, but you could get some volatility between those ranges that I showed you. That is what volatility is saying to me. What the Nikkei is saying to me is I don't expect much change either. You saw what the XLP, XLY said. It all says to me that the dips are going to be buys. Just leave enough room for to buy the dip at the levels that I suggest, and I don't think we can possibly go far wrong here. And with that, on to the biases. I'm not really too keen on being long 2s10s, because even if it breaks 117, but it's a range break and you probably get 3, 4, 5 basis points follow through. Not too keen on it, because I think at some stage it has to flatten. The Fed is close to acting. This is killing inflation expectations. I showed you those charts of the 5s and 10s break evens. They don't say that the bonds are going to move a million miles. They say that at some stage, when the bonds reach their technical levels, which are highlighted here, they will come back and the yield curve will then start to flatten. At the moment, I'm not really surprised at all that it's not flattening. I've seen this so many times before that you get a counter move simply because people are liquidating. Here are all my levels in the equities. I think that any dip down is going to be, this 43.18 to 42.55 area is going to be such a good buy. I just don't know how we're going to get there. I've showed you what I think volatility can do, but I think it's going to be a wonderful, wonderful risk-reward buy rather than a liquidation. Everything here, I think, while DXY is doing what it's doing and DBC is doing what it's doing and the bonds are doing what they're doing, gold really has very, very little hope. I would have thought the likelihood of trading 1675, 1658 is much higher than trading anywhere near 1830, 1850. Right, thank you very much indeed, and tweet you on Monday.